Hello, I'm presenter Anispeso and I'm giving presentations on investment portfolio from my client who recently inherited £100,000, and I'm recommending various range of investment opportunities which focuses on liquidity and growth while balancing risk and return. We will evaluate on different assets and amount of taps, implications on them, and the possible risk and returns to meet our financial objectives. We will also use efficient market hypothesis when selecting investment for the portfolios. Our main objectives is to achieve long-term portfolio growth while carefully analyzing the level of risk you are comfortable with. Investment portfolio. The growing influence of globalizations and innovations in financial market is making it harder for individuals to make to make personal investment choices. For individuals without relevant experience or knowledge, investing can be a complex and difficult process. Therefore, understanding the key regions, tools, and criteria for making diversified investment as an individual is highly important. Various factors such as economic crisis, inflations, financial illiteracy, exchange rate fluctuations, and stock market disruptions influence investment security and returns. The ideal investment scenario for an individual is one where returns are maximized to zero, whereas in real market condition this is unattainable. So investor must always take risks and return limitations into account. Our clients can invest on different physical and financial assets, including real assets, ordinary shares, gold, commodities. Real assets. Adding real assets to your investment mix can be a smart move. It can help boost returns, lower risk, guard against inflations, and give you more variety in a portfolio. The benefits of public uh, REITs, including strong returns, diversified portfolio experts, uh, management, and easy access to cash through liquid investments. A national survey from 2012 estimates that one in every eight American adults owns real estate investment property. The real estate sector added 4.9 trillion to the US economy, accounting for 18% of the nation's GDP, which is largely due to real estate being viewed as one of the most secure investment options in the 21st century. One advantage of real estate investment is its ability to act as a hedge against inflation, since property values typically increase alongside the rising cost of living. According to the Gordon growth model, real estate serves as an ideal hedge against inflation, unlike many fixed income assets, since it is a long-term investment that generates income which tends to rise with inflation. As the demand for real estate growth, it will lead to high property prices and rental rates. In 2020 to 21, the average appreciation rate, which is the average increases in the real estate price for the houses in the US, was 18%, while historically houses in the United States only appreciate by 2 to 3% annually on average. Unlike many other income-generating business, real estate investment provides significant tax advantages, meaning the rental income earned from properties is exempt from taxation. Real estate can some Real estate has some drawbacks as well. The disadvantages of property investment include large upfront down payment typically required by lenders, the illiquid nature of real estate assets, and the extended period needed to see tangible returns. Real estate lacks liquidity, making it difficult to convert into cash on short notice. The UK REIT sector is presently trading at a 9.8% to its net assets value, which is wider than long-term average discount 4.7%, but significantly improved from its recent low of 38%. UK real estate capital values are expected to recover in 2025, following a bottoming out across most commercial sectors in 2024. Declining inflation and reduced borrowing costs are likely to boost investment returns and drive a rise in real estate transaction activity in the coming year. As we can see in the table, according to the latest MSCI monthly data, the UK real estate values are currently around 25% lower than they were in June 2022. As of April 2024, the market industrial and residential properties seeing value increases, retail properties remaining stable, and office spaces experience a declining. While this slowdown doesn't ensure that property values will soar at the overall market level, makes it does make it a relevant time to discuss a relative value. Ordinary shares. We can also invest in ordinary shares issued by individual companies. When you buy shares, you become a partial owner of the company, which grants you some voting rights and benefits beyond just earning a portion of the profit. However, individual investors typically have limited influence over company decisions compared to large institutional shareholders like pension funds. The price of a stock on the exchange is not constant. It can be rise or overall or fall based on the balance between demand and supply, and these price fluctuations in the capital market are part of what makes the market appealing to certain investors. The Financial Times Stock Exchange is commonly seen as the key indicator of the UK economy, but in truth, it is likely more connected to global economic brands. The FTSE 100 currently offers a dividend yield of approximately 3.5% a year, indicating that dividends makes up around half of the overall return investor receive. By the end of 1999, the FTSE 100 reached a high of 6,930, and over the next 2 decades it increases to 7,542, and by the end of 2019, a rise of only about 600 points when factoring in dividends. The total return over those 20 years was approximately 122, averaging around 4% annually. As we can see here in the total shareholders return over different period of time, and the dividend per share of the Google, where the dividend per share is 0.8 dollar, and the dividend yield is 0.5%, and the payout ratio is 9.95%. And in the income statement of the Google in the last 12 months, Alphabet had revenue of 350 billion and earned 100 billion in profits. Earning per share was 8.4. And gold plays a crucial role in investment strategy, as it serves as an economy has offers protection against inflations, add diversification to investment portfolios, and is widely regarded as the ultimate safe haven assets during times of crisis. Gold is influenced by short-term interest rates and often acts as a substitute for money, and the connections between interest rate and gold has been a topic of study for over a century. When interest rate rises, the cost of holding goes up, and leading to an inverse relationship between gold prices and interest rate. Gold is tangible assets priced in US dollars, so its value tends to move in the opposite direction of the dollar. Since Federal Open Market Committee announcements influence the dollar returns and volatility, they also have an impact on the gold market. Although gold is generally considered a low-risk investment, it does carry some level of risk. The primary risk is a potential decline in gold prices during the period you own it, as this is referred to as market risk. Although it may seem obvious that gold prices can fall as well as rise, it is a key point to consider when evaluating your tolerance for different types of risk. Gold is bought and sold in global market at a daily rate called the spot price, which is quoted in the US dollar per troy ounce. Investors see gold as a reliable way to keep their wealth safe. Over the past 10 years, gold prices have stayed above $1,000 per ounce, showing its long-term stability. Although gold has the potential for significant long-term value appreciation, it doesn't offer consistent income through interest or dividends like some other investments. As we can see the gold prices over 10 years, it has significant rise in the gold price. commodities. Since the early 2000s, agriculture prices have risen sharply, reaching record high during the recent financial crisis. The impact of these prices increases could be severe for developing countries where a significant portion of household income is spent on purchasing agricultural products. Institutional investors participate in both stock and agriculture commodity markets as a way to diversify their investment. Their trade behavior can create a connections between these markets, highlighting a key feature of the finalizations financializations of agriculture commodities. Commodity index returns tends to be more closely correlated with oil returns compared to non-index commodity returns, suggesting that index investing may play a role in the play a role in the financializations of commodity market. The commodity market primarily consists of spot and future segments. Due to the fragmented nature of the spot market, gathering price data and tracking information over the time can be challenging. In contrast, future contracts are standardized and typically traded on exchange, allowing these prices to efficiently reflect all over the market conditions. In many countries, the settlement prices of future contracts serves as a key reference point for OTC deals and global trade. And for the summary, I would like to suggest my client he should invest around 30% on ordinary share, 50% on real estate, and 20% on gold, where he got lesser risks in each investment and have the possibility to make profit in the long run.